Hello, everyone. Thank you for joining us this afternoon for the fourth installment of the Right to Market with Us webinar series. My name is Damo Sujanto. I'm the Head of Investment Partnerships and Solutions at UOB Asset Management, as well as the Chief Investment Strategist for our digital platform, UOB Invest. I will be your host this afternoon. And before we start, maybe a few technical housekeeping points. All the buttons at the bottom of your screen are multiple engagement tools that you can use. All the items are resizable and movable, so feel free to move them around to get the most out of your console space. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. We'll try to answer this during the webcast, but if the answers go too long or if we don't have enough time, we'll come back to you later. There'll also be several polls that you can share your views on what is likely to happen in the markets. Lastly, a resource list with some of the related materials available to you is available so that you can browse through them. So we started this series with an overview of 2021 investment landscape, where we highlighted our stronger expectation of Asian markets. In the second segment on the ground in Asia, we took a deeper dive into sectors of interest in various Asian markets through the lens of our investment team from across the region. Earlier this month, our Sustainability Office hosted the third part of the series where they share their insights on how we can turn crises into opportunities through sustainable investing. All these materials are available to you. You can actually go back and look at our the playback in terms of this series. Continuing from the sustainability megatrend, today's session will explore other innovative and exciting trends surrounding us and how we can tap on them. Now, to kickstart today's session, we prepared a short video to give us an overview on some of the exciting trends we see around us today. Indeed, welcome to tomorrow. Today we are privileged to have two distinguished speakers from our strategic partners at Wellington Management and Robico to join us at the fireside chat. First, we have Andrew Sharp-Paul, who's Managing Director and Investment Director at Wellington Management. As an investment director in investment product and fund strategies, Andrew works as part of the multi-strategy team in Asia Pacific region, supporting client solution and strategies. He worked closely with the broader investment team to help ensure the integrity of investment approaches by overseeing customization, portfolio positioning, performance, and risk exposures. He also helped manage business issues such as capacity, fees, and guidelines. As part of the investment team, he meets with clients, prospects, and consultants to communicate the investment philosophy, strategy, positioning, and performance. Prior to joining the firm in 2012, Andrew was a product engineer analyst at State Street Global Advisors and relationship management executive at State Street, Australia. Additionally, he held various roles within the Australian federal government. Andrew holds a Master of Applied Finance degree from Macquarie University and a Bachelor of Business Studies from the University of Technology, Sydney. Welcome, Andrew.
Thank you, Dharma. It's great to be here this afternoon.
Great. And our second speaker is Steve Bagaka, Senior Portfolio Manager at Robico. Steve is a member of the Robico Trends Equities since 2008 and Portfolio Manager of Robico Megatrends since 2020. Since 2019, he has also been portfolio manager of Robico Digital Innovations. Previously, he was trend researcher within the trend equities team and has authored several white papers. Before that, Steve was portfolio manager of Robico Infrastructure, Equities, and Robico Holland's Visit. Prior to joining Robico in 2008, Steve held different functions at Institute of Research and Investment Services, or IRIS, the former research joint venture of Robico and Rabobank. From 1998 through 2008, he served as head of IRIS Equity Research, and before that, he worked as equity analyst for 8 years. Steve started his career in the investment industry at Robico in 1990 as an analyst. He holds a master's in monetary economics and finance and investments from Erasmus University, Rotterdam. Welcome, Steve.
Hi, Darmo, and good afternoon, everyone. Very excited to be here and exchange views on trends and themes that we have been investing in at Robico for the last 12 years or so. So, yeah, looking forward to this event.
Great, glad to have you. Well, the COVID-19 pandemic last year has accelerated many of the megatrends that have begun in the last decade or so. Many of these trends were expected to play out in the next few years or next several years. But what we have seen is that it's really been fast forwarded to today. I think that's why our topic, our webinar title today is Welcome to Tomorrow, because we believe tomorrow is here. Before I get my speakers to give us their views, I would like to start by hearing from you in the audience. We have a couple of poll questions along the way to get your views. And can I now have our very first poll question? There are various ways in which we can define megatrends. And this poll question is written based on PwC's definition of PwC's categorization. But if we are to look into the next 5 years, what do you think is the most important megatrend you see in the next 5 years? Is it 1, demographic change, 2, shift in global economic power, 3, rapid urbanization, 4, rise of technology, or 5, climate change and resource scarcity? I think these are all important megatrends. If you can click on your screen and let us know what you think is the most important megatrend. Okay, let's take a look at the answer. Wow, rise in technology. Great. I think it's great. And climate change comes a very close second. Almost 90% of the audience basically think rise of technology and climate change would probably be the most important megatrends. Then you are in for a big treat, because I think these are the issues that our guests would be speaking on today. Maybe for a start, Andrew, what do you think? What would be the most important megatrend for the next 5 to 10 years from your vantage point?
Yeah. Thank you again, Damo. I think it's really interesting the way you set up this particular session to describe not only the impact that COVID has had on accelerating a lot of these trends, or at least the appreciation of them. But I think more importantly in your opening statement was the fact that these trends were in existence before COVID. I think there's quite often a tendency to think of COVID as creating a whole bunch of new opportunities. But I think the first thing we would say, and I think Steve mentioned this, kind of briefly in his own comments, is that these are themes and trends that have been investable for some time. A lot of the ones we're going to be talking about. Certainly, COVID has accelerated them, but absolutely they're existing and they're investable, which I think is most important. In terms of themes that we think about at Wellington, maybe I'll take just a quick step back, if you don't mind, to kind of discuss how we come up with our themes and how we come up with trends. At Wellington, we have a proud long history of thematic research, and this is really based in a project which we refer to as Future Themes. This Future Themes project is a firm-wide project, which canvasses the whole of the firm to come up with interesting ideas that may be underappreciated by the market. And these are typically longer-term themes, themes that may be misrepresented by the market or underappreciated by the market, or haven't yet really risen to common knowledge amongst market participants. So we've been doing this process since 1981, and it just so happens that in 2019, just before COVID, we actually began our latest iteration of this research. And I'm proud to say that UOB Asset Management has actually partnered with us in this, as you know.
Yes.
So the two themes I'll highlight have come directly from that. And the first is, and actually again, what's interesting is the intersection of the two highest voted answers in your question, the rise of technology and the impact of climate change or resource scarcity. Both of these themes are directly related to that. It could be at the juncture, I suppose, of those two issues. So the first is climate change, and the second is automation. So in the area of climate change, we think about three key ways to think about investing around climate change and the unfortunate events that are going to stem from that. The first is related to mitigation. So this is the trend towards electrification and companies that can actually help mitigate greenhouse gas emissions and hopefully slow the path towards global warming. The second is transition, and this is the change in energy structure. So the change in the kind of energy sources we're using to help power the global economy over time. So the move from fossil fuels to renewable energies, as an example. And the third piece is adaptation. And this last one, I think, is somewhat underrepresented or underappreciated by the market because it happens to be the most uncomfortable of the three. It's very easy to talk about mitigation, and it's very easy to talk about transition because both of them are quite positive in orientation. We're trying to stem the worst of climate change, and we're trying to help the world mitigate the risks. But adaptation is somewhat of an understanding that a lot of the damage has been done, and we're already experiencing climate change. So adaptation is more about trying to identify companies which are aligned with the opportunities presented by adverse weather conditions and climate adjustments. So this could be things like air conditioning companies, swimming pool distributors, very important for us here in Singapore. It can also be agricultural advancements, technology as well. So that's really a key way to think about that particular trend. The final one, because I realize I'm taking up a bit too much time perhaps, is automation. And automation is critical because of climate change has a part to play. If you think about agricultural work, for example, as climate increases, as temperatures increase, a lot of manual labor will just become very, very difficult. So automation, machinery, and robotics may play an increasing part in our agricultural processes, or getting better at seeding, better at planting, increasing yields. But also with COVID, the risks of virus transmission, especially on very busy factory floors, has been really acute. And increasingly, we're seeing actually robotics demand pick up significantly or remain very robust at least. And a lot of this is being driven by the need to automate and the appreciation that factory floors need to get better. And aligned with that as well, kind of a corollary, is that robotics also increases sophistication of a lot of the processes we have in place today. So it can increase efficiency of identifying defects. It also has a part to play in enterprise automation, so getting better at using low or no code systems for streamlining business operations. And also in areas like medical, so using robotics for surgery or using robotics or automation for identifying rare diseases or assessing rare diseases and identifying cancers. So they're the two themes that I'm most excited about. I shouldn't say I'm excited about climate change. I'm two that are most interesting to me. And so climate change and automation. Okay.
Interesting. I never thought of swimming pool maintenance as being part of the investable universe for adapting to climate change. Interesting point of view. But I mean, in terms of robotic surgery, in terms of telemedicine, definitely it's something that's really exciting, exciting development, especially in some of the more remote parts of the world. Steve, if I may come to you, what do you think? What are the trends that excite you?
Yeah, well, Dharma, I will definitely side with the audience on this. We do also think at Robico that technology is probably going to be one of the most important megatrends for the foreseeable future, and certainly in the next couple of years. A couple of reasons. One of them is that technology is the prime driver of economic growth, and also by extension of economic value creation, which from the point of view of investors, of course, is very central. What we also like about technology is that it tends to develop in a non-linear fashion, whereas most people tend to extrapolate in a linear fashion, which means that some of these technological trends tend to be underestimated by the market. And provided that you are able to spot these trends as an investor before the market does, that gives you an opportunity to earn very attractive and excess returns.
In other words, things happen slowly until it happens suddenly.
Exactly, yeah. And we've seen many examples of that. Within technology, there are several interesting technologies, but one of the most pervasive ones and most relevant ones in our age is, in our view, undoubtedly digitalization, which basically covers every industry that we look at. And the whole transition, let's say, from a physical economy to a cyber economy has very interesting economic implications because many digital products and services are so-called non-rivalrous goods, which means that they can be consumed simultaneously by different people, which is not the case with many physical goods. For instance, if you drive a car, I can drive it at the same time. But if you consume a piece of software, I can use it at the same time. And so this gives rise to increasing returns to scale. And that's a very interesting dynamic, of course. It also means that because of connectivity coupled with digitalization, you have, once you have developed, let's say, a piece of code or software, you have nearly zero marginal cost of production and distribution, which means that it's very profitable for companies that engage in those kinds of activities. And I already mentioned connectivity. When you sort of wed connectivity with digitalization, you can get all kinds of interesting new innovative business models, which can profit in many cases from network effects. And network effects have the tendency to lead to winner-takes-most dynamics. And we've clearly seen that play out over the last couple of years, where you see a few companies producing most of the economic profits in the world. So that's the reason why we think that's a very interesting area to be involved in as investors. I would like to highlight perhaps two areas where we think currently there are especially attractive opportunities, although there are many outside the two that I will highlight. But the first of them is financial services, which is partly about the digitalization of all kinds of business processes that would make traditional banks and financial service providers more efficient. But in our view, is primarily about, let's say, the move from physical cash to digital cash, which is much more convenient and is driven, we think, to a large extent by the shift to online activities. Because in an online environment, it's simply impractical to use cash in many instances, and in some cases, it's even impossible. And that has definitely been boosted by COVID, we think. but as Paul already mentioned, that trend has been in place, but is definitely accelerated. And the interesting thing is that this still has a large runway for growth, we think, because still in most regions in the world, cash is dominant. I saw a fairly recent report where it said that in North America, still 80% of the transactions are done in cash. And in Asia Pacific, for instance, it's about 60%. So that's still a large opportunity for players in this area. And so, yeah, we think that's an interesting opportunity right now, and especially for the companies that are specialized in providing these services, the so-called fintech companies. And it will be a much tougher challenge for the legacy players, the traditional service providers. Second interesting area, I think, is mobility or automotive. A lot of people talk about the shift to electric vehicles these days, and it's certainly a very hot topic in the markets today. But in the end, we think it's destined to be an area where there's going to be a lot of competition, bloody competition, and in the end, low profits. So we think this is an area where there are definitely risks of disappointment. A statistic that gets us really excited, however, is that the level of computations in cars has gone up dramatically, almost by a factor of 10 million times since 1990. And that's a compound average growth rate of more than 80% annually. So that's a staggering statistic. And we think that if you combine this increased computational power, sensors, and connectivity in cars, that you have a very interesting development ahead of the connected car, which eventually will lead probably to autonomous driving, although we are clearly not there yet, and also an opportunity for new business models that will revolve not about car assembly, but about monetizing the data that gets generated by users, by consumers, and it gives companies opportunity to directly engage with their customers. Obviously, Tesla is one of the companies that is very active in this area, but it's very interesting to us that we are now also seeing the big tech companies like Apple and Google about to enter this area as well, and that's something to watch very closely. Currently, we think that the most interesting opportunities to invest there are in that computation capacity that we alluded to, and in the increasing amounts of sensors in cars. So that is currently where we are invested in, but we are looking forward to the next opportunities in that space.
Great. I hope our management at the bank is listening to this webinar when you talk about digital banks and the digitization of banking services. Well, it's interesting to note that both of you talk about the rise in technology as a major trend. I think, in fact, I think what we are doing today is a testimony to that rise in technology. I think 2 years ago, if you told people that we are going to have a seminar with participants in 100 different locations, speakers in 2 different continents, most of us would probably laugh it off. But hey, here we are, and basically what we've seen is really that rise in technology and that rapid adoption. I think as famous science fiction writer Arthur Clarke once said, any sufficiently advanced technology is indistinguishable from magic, and I think what we are seeing is really magic taking place today. So
absolutely,
definitely excited about it. Let's go to the second poll question and hear from the audience again. What do you think? We are in Asia, and we are definitely interested to see if there's in any areas do you think that Asia is leading in terms of megatrends of innovation, right? Number one, artificial intelligence. Number two, digitalization. Number three, urbanization. Number four, all of the above. Number five, none of the above. So I'll give you a few seconds to think through which areas do you think Asia has a leading edge? What do you think, Andrew?
Yeah, it's a very important question, and I think that it's always very difficult to say which region is leading. I think quite often what it comes down to is specific companies that have the necessary technology and the moat and the powerful business position to be able to lead. And I think one of the key things we see, this is kind of related to a lot of what Steve talked about as well as the automation point, is if you think about a lot of the automation just as a general trend, there's a lot of different components that are important to making automation successful. One of the exciting areas that we think about is machine vision, which is probably not too dissimilar from the sensors Steve was referring to. And machine vision in this instance is what it sounds like. It's the ability for machines or automated processes to be able to identify things in front of them, but not only identify, process what they're seeing, and then form an action. So, the simplest example of this is a production line which has, you've got goods coming along it, and you're trying to identify defective goods. In this instance, machine vision allows the robot to identify it and then pick out the process what it is and then remove it from the thing. And a lot of the companies that are leading in machine vision are actually based here in Asia, particularly Japan and South Korea.
Okay. Sorry, Andrew, I'm going to cut you off for a while. Let's hear from the audience.
No
Let's see the poll results. Wow, all of the above seems to be the one that people think that garner the most votes. I think there are a lot of optimism that Asia is leading in some of these areas. I think we do see, for example, I think in digital payments, probably China is one of the most advanced countries in terms of pushing digital payments. The joke was that you can actually give money to a beggar in the streets of China using a QR code, right? So those are some of the interesting things that we see. Definitely, yeah. Andrew, you talked about machine vision just now, and I think that's definitely interesting. And there are the sort of the views of the idea that China seems to be destined to rise faster in terms of artificial intelligence, simply because it's about data, and China is probably gathering the most data that we've ever seen across the world. That, by definition, gives them an advantage, right? So I think it's definitely interesting to see where else we see Asia could really be in the leading edge in terms of this innovation. But Steve, what do you think?
Well, it's certainly true that China is leading in some areas in artificial intelligence, but it's not a uniform field of activity. I mean, there are many different aspects to it, China is very good, for instance, at facial recognition technology. But that doesn't mean that it will excel in other forms of artificial intelligence as well. For instance, let's take natural language processing or something like that. You can't really extrapolate that through all the other areas. But you are absolutely right that access to data is key, because many of these programs need to be educated and tend to be self-learning, but they can only learn when they are provided with sufficient data. So that's absolutely true. By the way, I learned that Singapore is #1 country when it comes to AI readiness, according to a report from 2019. So congratulations with that.
Thank you. Although I'm not sure how much data we generate. We just, unfortunately, our population size is probably just too small in terms of generating.
That's a disadvantage, of course, but at least you are ready for it, to adopt it.
Okay. Andrew, any further thoughts? Anything besides machine vision that you see?
Yeah, I suppose the point I would make when I think about Asia driving a lot of these trends is not only on the innovation front. I think the other important aspect here is the demand side as well, so the macro side. And I think, if we move away from perhaps the technological aspects of things for a moment and think about the other major trend that was highlighted in the survey earlier, which is climate change or sustainability, I think we've also seen some leadership in the region, both from a macro perspective and also a company perspective as well. So the macro side of things, you've seen, obviously the big news last year was China's announcement to go to net zero by 2060. We've seen similar commitments from Korea. I think Korea has passed in law. Japan has made a similar commitment. Here in Singapore, although the government hasn't committed to net zero, they have put in place a low emissions development strategy. So there's a lot of leadership in the region in terms of ensuring a greener future, if you will. So that's always encouraging. I think the other thing, from the company perspective, what's really interesting when you think about the aspect of renewables, a lot of the leadership and a lot of the technology, well, actually, I should be careful here because Steve is from a part of the world where they're known for their renewable energy capabilities. But here in Asia and in emerging economies, they've certainly driven a lot of the innovation as well. And China is obviously a standout in that regard. So, you think about, the largest wind producers in the region are from China. We also have, some of the world's biggest solar glass suppliers. Another where, Steve mentioned electronic vehicles before. There's some really innovative electric vehicle companies, both in India, but in China as well. And the other thing which I'd note, Steve mentioned sensors as being a really key part of the electric vehicle opportunity set. The other one which we think warrants more and more attention is actually the batteries themselves. As we move towards this electrification of the economy, the economy, not only do those electric batteries need to fill their demand in electric vehicles, there's also going to be increasing use of them for storing power, distributing power as well, as we seek to better handle, control, and store energy supplies. So batteries aren't infinite supply. So definitely, I think demand for batteries is going to increase, and also battery innovation as well, as we move for better advances, towards having an efficient and effective solid state batteries, for example. Those types of things, quite often, those types of advances are actually being discovered and happening right here in Asia.
Great. I mean, it's interesting and exciting to see that there are areas in which that we see sort of leading companies emerging out of Asia in some of these mega trends and in innovation. Now we come to a segment that probably everyone is most interested in. What does it mean for your investment portfolio? Before we go there, maybe another poll question. Which do you think is the most profitable sector to invest in the next 3 years? Okay, so for the audience, I'm giving a sort of 3-year investment horizon. Do you think it's electric vehicle? Do you think it's e-commerce and digital platforms? Do you think it's renewable clean energy? Do you think it's cloud computing and software? Or do you think it's healthcare? which are the areas you think are probably the most profitable sector to invest in the next 3 years? I'll give you a few seconds for that. Right. If we can see the answer to the poll. Wow. Okay, we have a very, it's interesting. We have a very sort of spread out, a very well distributed views from the audience. I mean, basically, even the one with the highest vote count is probably only about a quarter of the audience. So I think it's healthy. I think at least we are not seeing an overcrowding into any particular sector. But maybe for Andrew, what do you think? What do you think is the most exciting part of this sector? So is there any other particular sectors that you are really keen in?
Yeah, I suppose you've got a very good distribution here, and I think the audience has highlighted one of the key focuses of any investment, and that's diversification, Damo. So nice. I think a portfolio that was broadly aligned with this would probably do reasonably well. And I think what's one of the keys here.
For you.
That's right. And I think one of the key points here, I'd make. I mean, I think you can choose any one of these, and I think they're all likely to be attractive investments over the long term. But I think one of the key points that I always make when I have discussions with our clients around investing in trends or thematic opportunities is that diversification is quite often your friend. If you take any one of these themes individually, you can get quite significant levels of volatility. And you also have difficulties managing, what we refer to as the hype cycle, which is a Gartner hype cycle. I think is the academic who coined the term. So having a diversified portfolio can allow you potentially to mitigate some of those risks around investing that hype cycle and getting your timing wrong. Because at the end of the day, a lot of these themes, at least over the short term, are very momentum oriented. So timing and investment can be both tricky and either rewarding or have quite adverse impacts on your capital. So yeah, diversification is always an important lesson in investing.
Great. And Steve, your thoughts?
Yeah, I completely agree with Andrew, and I was in fact going to make the same points. It's very difficult to near impossible to time market sentiment, and even though some trends and themes will play out over many years, they do tend to get in and out of fashion among investors. And it's very difficult to time those inflection points. So I think indeed, if you want to be an investor in trends and thematics, some degree of diversification is very healthy and very good from a point of risk management. And in fact, in our portfolios, we always have a couple of trends that we hope are not too correlated in terms of the periods that they outperform. And so, for instance, in the portfolio that I currently manage, we have 4, let's say, major megatrends, and we have broken them down into smaller pieces. 11 at the moment of, let's say, sub-trends or themes, and within those we even have some further granularity as well. So we do take that very seriously, that diversification, and so far it has worked fairly well for us. It does mean that you're not always in let's say the top quartile or top 10% of performers. But it's important to live to fight another day in this business, as we all know. At least if you have some time in the market. So we completely agree. As far as the trends that you showed in the poll, E-commerce and digital platforms is very interesting, very attractive business models, and perhaps for the coming few years, interesting in the sense that we have seen this acceleration due to COVID. But we are currently at a moment in the market when a lot of people are wondering how much of that spike was temporary and whether we will fall back to much lower levels of adoption. And actually, we think that the adoption will stay at a permanently higher level, although we will see some deceleration there, obviously. But as a consequence, we think this is actually perhaps a very good time if your investment horizon is, let's say, the next 3 years, as you posed in your question, I think, to be invested there. Cloud computing software, we think, is also very interesting. But cloud computing is currently mostly embedded in the activities of very large companies that are also moved by other factors. So that's not all that easy to be exposed to, especially, let's say, with the exception of some of the software companies that provide cloud software. But yeah, software is a very broad category, and there are some attractive segments and some segments that we are not so hot on. So it's a mixed picture there, I would say. And healthcare, same. Some very interesting areas in areas like gene therapy, and currently very topical, of course, the messenger RNA vaccines, and related to that immunotherapy. Liquid biopsy is, we think, a very interesting growth market for the next few years. Telehealth, interesting. But we are less enthusiastic about traditional pharma or the managed care segments in that sector, or also generic medicines. So, again, a mixed picture. And as I mentioned earlier, the electric vehicle market, we do have some doubts about whether that's going to be, in the longer term, a really good place to invest, because we do think it's a bit too frothy. And there's a danger, we think, that people are suffering from the delusion of the big market, that everybody is talking about how big a market that is. But in the end, there are so many new entrants, and there are so many legacy players that will not simply roll over and play that we foresee very high levels of competition and perhaps less opportunities for investors to reap the returns, at least the ones that we have seen last year.
Damo, if you allow me, if you'll indulge me for a moment, I was looking at some stats before the session, because I was thinking about e-commerce, as Steve kind of mentioned. It's been a hot topic, obviously, for the last 18 months or so. And I was thinking about that trend. If you go all the way back to Amazon's kind of launch as a company in the dot-com era, there's some really stark numbers just to kind of illustrate some of the volatility that you would have seen, using Amazon as a proxy for e-commerce. Obviously, there's more to the theme, but just as a proxy. So from June 1997 to November 1999, Amazon share price rose 5,000%. Subsequently, from November 99 to September 2001, it lost almost all of its value, down 93%. Then since that point to today, the stock has now risen over 51,000% cumulative. So it gives you a sense, that's obviously a very extreme example, but when you're investing in themes and trends, you need to not only understand the time horizon that you're willing to invest or you need to invest. So you said 3 years. I think a lot of these themes are 3, 5, 10-year themes, but also it's an appreciation of the kind of risk you want to hold as well. So being very concentrated in a single stock like Amazon through that period would have been rewarding, but would have come with a lot of volatility. You would have had to hold your nerve. So the more you diversify, the more smooth that ride can potentially be.
Sure, definitely. Makes sense. Okay, we've come to the last segment of our webinar. Let's look at the fourth poll question that we have. Which sector would you avoid in your portfolio? Right, let's hear from the audience. Would it be coal and oil that you don't want to touch with a 10-foot pole? Is it traditional car makers? Is it palm oil? Is it all of the above or none of the above? Right, again, I'll give you a few seconds to make your decision. What is it that you don't like or you don't like the most? Okay, can we take a look at the answers from the audience? All of the above. Okay, that's 41% of the audience says they don't like any of these sectors. Well, okay, maybe if I can let Steve address this issue. I mean, Steve, how does Robico look at this trend investing? Is it really just a matter of avoiding some sectors, excluding some sectors from your portfolio? What's the Robico's approach?
Well, we do not take an upfront view on sectors or industries that we would like to avoid. We simply look at the investment characteristics first and let that determine what companies and consequently sectors and industries we would like to be invested in. Referring back to the questions, these are all sectors and industries that we are currently not invested in because we simply think that the structural growth opportunities in those sectors are not very enticing. Obviously, there will be tactical opportunities to profit from temporary mispricings. But from a structural point of view, we think there are simply too few opportunities to invest in these areas. And I would say in general, when we look at trends or themes that we considering for investment, there are three criteria that we look at. First is size. Is the market, the total market size, big enough to invest in? And we look in that respect at the number of pure plays that we can find. What is the total addressable market for those activities? And especially, do we think there are enough opportunities to profitably invest or reinvest profits? Because that is driving longer-term growth in the end. Second criterion is timing. And Andrew already referred to the Gartner hype cycle. That's certainly something that we consider as well. And generally, of course, we try to get invested just after or ideally before the positive inflection point of adoption of new products or services. So in terms of the Everett-Rogers adoption curve, that would be, let's say, the point when the innovators make way to the early adopters and the early majority. We think that's generally the sweet spot to be invested in. That's often quite difficult, and perhaps we'll have some time to discuss some of the tools that we use in addition to the Gartner hype cycle. Third criterion is simply profitability, or the prospects of monetization, because in the end, of course, it all comes down to the potential for companies to earn more on their investments than their cost of capital. And that's something that we look very closely at. Doesn't mean that we avoid investing in companies that are currently not profitable, but then we need to have a very strong view on whether they will be able to earn their cost of capital in the not too distant future. So those three criteria are important for us. In terms of the timing, there's a tool that we are very excited about and that we make a lot of use of, and that is the company life cycle. So we look at about a universe of 10,000 companies that we can categorize in 4 categories in terms of their life cycle. And there are 4 stages that we distinguish. First is the startup phase, when companies are not making money and still have to prove, let's say, their economic viability. It's usually characterized by high investments, low or no profits, high and very volatile valuation multiples. And it's a category that potentially could hold the winners of the future. But we are very mindful that, let's say, the mortality rate in that stage is very high. And in fact, we think that only 1 in 8 of those companies makes it actually to the next stage, which is the high growth phase. And that's one of the areas that we are really looking for. How many companies are active in that phase of the life cycle when we look at a certain trend. And in this phase, the companies are earning their cost of capital or more than their cost of capital, and so they have proven, let's say, their economic viability. But they still have lots of opportunities to further reinvest the money that they make into new profitable investments, which means that the compounding rate of economic profits is highest in that stage of their life cycle. And so because we are looking at these long-term compounders, we think that's very interested to be heavily involved in this stage of the life cycle.
Great.
And then, sorry, you were going to say?
No. Sorry. I said great. Really, it's interesting just to see that you guys do a lot of research and studies on all these companies to try and catch this sort of high growth compounders. Yeah, but we also are invested in some of the more mature companies when there are less opportunities perhaps to invest new money, but where we can still find companies that are highly profitable, and because they don't have to invest that much, they tend to be highly cash generative. And from a portfolio construction perspective, it's also good to be invested in a number of those companies because they tend to be less volatile than the companies that are active in the high growth phase. So let's say the high growth phase and maturity phase are the companies that we mostly invest in our strategies, and we occasionally take positions in companies that are really in the startup phase, but we really structurally avoid companies that are in the declining phase of the life cycle. And to come back to the question, that is where we think a lot of the coal and oil companies are currently positioned. Traditional car makers are in that category as well, we think. Palm oil is, I think basically in the same category there as well. So, typically some tactical opportunities there, but from the point of view of a structural growth investor, we do not go there. Okay, Andrew, how about you? I mean, how does Wellington really look at this? What's the investment approach of Wellington in this area?
Yeah, I think, perhaps unsurprisingly, in our thematic portfolios, and we manage both single theme portfolios and multi-theme portfolios, we take a similar view. There's a lot of focus on identifying companies that are pure plays on the specific theme. There's a lot of risk if you look at a lot of thematic portfolios in the market. Quite often they hold large conglomerates that have a very small part of their business tied to a specific theme. What we look for instead are companies that are actually driving the majority of their revenues from that thing. So we think about it as a purity threshold from a revenue standpoint. And that's also very important. Obviously, risk management is critical. There's been a few questions coming in, I can see, on managing the volatility. You can do that a couple of ways. The easiest way is obviously through diversification. So yeah, I think they're all, I would agree with a lot of the points that Steve made. The one thing, perhaps just to be controversial and to provide a little bit of a point of disagreement, perhaps, with some of the comments Steve made, was just on the traditional car makers. We think obviously there are really, there's a great number of exciting entrants into the EV vehicle market, a lot of which are, entering the market through SPACs, which it seems all the craze at the moment to be talking about those. And we do think some of those will be winners. Some of those will definitely not be winners. And it's identifying those winners and separating them from the losers that's critical. But at the same time, we do think that some of the traditional car manufacturers as well will also be successful, just given their place in the market positioning, the manufacturing they have, the expertise they have in the space. I think for us, we do think there's some opportunities there. In oil and coal, it depends how you think about oil and coal. If you're thinking about people who are extracting coal from the ground and distributing it, something that my country loves to do, I think that's not a space where we're investing. We're definitely avoiding, as a firm, typically those types of companies. But if you're thinking about some of the larger, vertically integrated conglomerates on the energy side, I think the reality is that a lot of those companies are going to have to help in the energy transition. So to completely discount them, it seems a little bit premature. So again, it's really about critical bottom-up security selection and fundamental research to identify which companies are likely to survive and which companies are likely to struggle. And a lot of those companies that survive are going to be the ones that are able to adapt and change to what is an ever-changing world.
Great. Well, that's good. I mean, just nice that you sort of lead us into the Q&A. I think you just now mentioned that there was a lot of questions out there. And I think the one area, also the elephant in the room that everyone is asking is definitely one, what do you think of cryptocurrency or digital assets? I think is that part of our future? What do you think, Andrew?
Yeah, there's been a lot of really interesting articles recently on non-fungible tokens, digital artworks, which have reached crazy amounts of money. You can buy clips of basketball highlights. That is not an investment that we're advocating. That's definitely a niche market, and you really need to know what you're doing or have a very strong tolerance for risk. Now, on the cryptocurrencies, which I think is where a lot of the attention is focused. To be perfectly honest with you, I have no view on where cryptocurrencies are going to go. It is a very difficult asset class to value. I think what's critical, though, from the cryptocurrency, let's call it revolution, is a lot of the underlying technology. So blockchain technology and how that can be used for transactions, for digital banking, for financial services companies, but also other companies to help secure processes more effectively. Quite often the question that's tied to cryptocurrencies is using it as a replacement for gold. Now, this is something that I probably disagree with. I think it doesn't make intuitive sense to me to think about cryptocurrency as an exchange, as a replacement for gold. When I think about the benefits of gold, two things really spring to mind. First off, one is its role as a store of value, which is driven by scarcity, and the other is its use as potentially as an inflation hedge. Now, on the scarcity point, Bitcoin, through its very clever programming which I'll never be able to understand, is designed to have some scarcity value through the way the mining works. So within Bitcoin, there's an argument to be made that there's scarcity, which adds a store of value. I think the risk to that view, though, is that in such an area that's so innovative and has so many competing cryptocurrencies, is there the real risk, in my mind, is that Bitcoin becomes obsolete. And we then move into a different variant of cryptocurrency that overtakes, that's better, that's more efficient, or does something that I'm not clever enough to know yet. So while Bitcoin is scarce, there is a risk that it becomes obsolete through innovation, was one thing. On the inflation point, or just a hedging point relative for volatile markets, through our own analysis, what we've seen is when we see equity markets fall around 10% or more, Bitcoin, rather than being a hedge, it actually falls on average 30%. So as a diversifier to equity risk, it hasn't proven itself yet to fulfill that role. Similarly, when we think about it as an inflation hedge, based on our analysis, using statistical techniques such as principal component analyses and the like, there doesn't seem to be a strong relationship either there as an inflation hedge. So the jury is still out on its hedging uses as a hedging tool.
Great. Steve, what do you think? What are your thoughts on cryptocurrency?
Yeah, well, let me say first that I do not claim any expertise in this area, but obviously we do have some views on it. I tend to agree with some of the points that Andrew made, although I have become a bit more optimistic, and no pun intended, a bit, about Bitcoin. A couple of years ago, we thought it was a very interesting experiment, and especially we thought the underlying technology of distributed ledger technology was very interesting and could have broader application. And Bitcoin itself, yeah, we thought it could succeed, but the chances of that happening were very small. But given recent developments, when we have seen much broader adoption by serious parties, for instance, BlackRock has entered the Bitcoin space. Obviously, PayPal and Square have recently started to facilitate trading in Bitcoins and exchanging it. We think that it is possible that Bitcoin has sort of, or is very close to getting to the stage of escape velocity, if you will, and that their network effect might be strong enough to really establish it as a leading digital currency. And yeah, of course, because the supply is fixed due to the way the algorithm is structured, 21 million Bitcoins is the total maximum amount, and you will increasingly get closer to that amount. If the adoption is strong enough, so the demand is strong enough, it follows inexorably that the price will go up. And it will not go up in a straight line, of course. It will be very volatile, but it will go up over time if the adoption is strong enough. So that's, I think, a very interesting dynamic, and it's possible or probably the reason why a lot of investors are taking a closer look at it, because if that point is indeed reached, it would have very desirable characteristics from an investment point of view. It would indeed provide, over the longer run, some protection against inflation, and could fulfill some of the roles that gold is fulfilling right now. So I tend to be a bit more optimistic now that we have seen some serious adoption by serious companies. So that's my view at this point. But again, I do not claim any deep expertise here.
Yeah. So basically, you believe that the wider the adoption, it becomes valuable simply on that the network effect starts kicking in.
Yeah, And I do think the network effects have been getting a lot stronger. Certainly when you look at Bitcoin relative to other digital currencies. And then one of the things that people look at, I think, is the hash rate, which needs to go up to become more secure. And if you compare the hash rate of Bitcoin relative to other coins, it has gone much higher than for other coins. And I think that will only strengthen the attractiveness of Bitcoin relative to other crypto coins or currencies.
Okay, great. Okay, the next question is probably out of my, personal interest or private interest, self-interest. We just now talk about in terms of digital payment, in terms of banking. How do you see banks fit into the future? I mean, are traditional banks destined to be dinosaurs? To be overtaken by the new banks and the new digital payments providers in that area. How do you see the sort of traditional banks? Andrew, if I may address that question to you.
I was worried you would come to me first. This feels like a trick question, Damo. And our strategic relationship with UOB is on the line here. No, so I think so obviously digital banks and digital technologies and transaction processes and the digitalization, which Steve has done a fantastic job of describing, definitely changes the playing field. And I think one of the outcomes of that is that you do get a lot of new players coming into the market. And I think that a lot of that technology, rather than being exclusively for their use, I think a lot of established banks can learn. And a lot of established banks with large capital, already large client bases that are able to adapt, much like those oil and gas companies I spoke about. They're able to adapt and evolve and change their business structures, can still survive. And there's absolutely still a place for them. So I think this isn't the death knell for traditional banks. The other thing which I would note is that, and we're seeing this, and we saw this to a large degree play out in November, December last year in China, is the risk of regulation. So there was a lot of media attention around Alibaba's intent to IPO their Ant Group, which is a large fintech company. And there was obviously a lot of media coverage around Jack Ma's comments ahead of that. And then we saw subsequently the implications of government intervention and now a much greater focus from a regulatory standpoint on the fintech space. So similar to Steve's comment on cryptocurrencies, while absolutely it's fair to say, in my mind, the digitalization of banking is a trend that's likely to stay and likely to become more pervasive over time. That path, much like the path of cryptocurrencies, is not going to be a smooth, straight line. So we'll have a lot of really exciting fintech companies that will come to market. A lot of those companies will end up finding themselves having to adhere to the same regulatory issues that traditional banks have to come under, and I think that's likely to throw a bit of cold water on a lot of these spaces. And that expertise in regulatory, in managing regulations and managing government relationships is an area which, let's be honest, traditional banks have a clear advantage and a lot of experience. So I think it's too simplistic, perhaps, to say this will happen or this will happen. I think what we're much more likely to see is over time a greater integration of fintech and digitalization into traditional banking systems, as well as a few new large players come along to both compete with and potentially merge with traditional banks.
Steve, I see you nodding your head. Do you have any thoughts on this?
No, I largely agree. I think traditional banks and the new challengers from the fintech space will coexist. But I do think that the advantage is definitely still with the fintechs, simply because they do not have to carry around some of the legacy problems and legacy structure, legacy infrastructure that traditional banks have. And that's a permanent disadvantage for the traditional banks, in my view. I think that still a large number of banks, for instance, process their transactions on mainframes dating back from the last century. And that's simply a burden that you have to drag along. And I have no doubt that many of the people working in traditional banking are seeing all the new opportunities and acknowledge of using new digital tools and services. But it's simply very difficult to change the organizations that are still so embedded in the past. So that's going to be a permanent drag, I think, for traditional banks, and it will be a factor of advantage for the newcomers that are not burdened by those legacy problems and that can develop all their products and services on digital infrastructure. So that's my view. But it's undoubtedly true that traditional banks will be around for a long time to come.
I think the concern is, can Facebook become a bank, or can Facebook really take over in terms of digital banking, especially I think a couple of years ago when they started promoting the possibility of having their own currency, Libra, within their system. I think that the concern is that the challenges are really coming from places that the traditional bank don't really see or don't really notice, rather than sort of a new digital bank, totally new digital bank that comes out. It could be from Amazon or from Facebook. I think in China, what we've seen is that it came from Alibaba. I think those are probably the issues that, or the possible potential threats that I'm worried that the traditional banks don't really see. But it's really been interesting to hear from both of you. I think we've run out of time, and I'm afraid we have to wrap up. I think if given enough time, we could have spent half a day here talking about all the various trends that are out there. Unfortunately, we don't really have enough time now, and we have to wrap up. So we've come to the end of the 2021 Investment Outlook. We invite the audience, you in the audience, to scan the QR code to give us any comments or any feedback that you have for today's session. I think that will be helpful in terms of us planning for future sessions. And before we end, we'd also like to remind everyone that you can watch the playback of our entire webinar series on ubam.com.sg/playback. Right? That's where you get access to all our past webinars and resources. While we may have come to the end of this series, do continue to keep an eye out for future exciting sessions that our team are planning for. And so at the end, I basically want to thank Steve and Andrew again for joining us, for being such a great panelist in our webinar. And thank you for being a great audience today. Goodbye.